Here's something that should make every investor pause. While Wall Street celebrates near-record stock prices, the bond market is screaming a completely different story about America's economic future. This contradiction between what stocks and bonds are telling us reveals a troubling disconnect that most people are completely missing. And here's where it gets controversial. One of these markets is about to be proven dramatically wrong. The bond market, often considered the smarter cousin of Wall Street, is flashing warning signals that suggest our economy might be on shakier ground than the euphoric stock market would have you believe. Recent employment data has revealed cracks in what was previously considered a rock-solid job market foundation, sending investors scrambling toward the perceived safety of government bonds. This flight to safety has triggered a significant bond rally, which in turn has driven Treasury yields to their lowest points in years. The 2-year Treasury yield has plummeted to levels not seen since 2022, while the benchmark 10-year yield has crashed to depths last witnessed in April, coinciding with President Trump's announcement of his sweeping tariff strategy that initially spooked markets about potential economic deceleration. But here's the part most people miss. Declining Treasury yields aren't just numbers on a screen. They represent Wall Street's collective bet that our economy is weaker than anyone wants to admit, and that the Federal Reserve will be forced into aggressive action to prevent a more serious downturn. The Federal Reserve, which has maintained its key interest rate at current levels since December, now faces overwhelming market pressure to reduce rates at this week's crucial policy meeting. The reason? Employment data that's deteriorating faster than most economists predicted. Investors are rushing into Treasury bonds to secure today's relatively attractive rates before the Fed inevitably cuts them. Consider these sobering statistics that emerged just this week. The Labor Department reported one of the most significant weekly spikes in unemployment claims in over 12 months. This alarming development followed earlier revelations that August's unemployment rate climbed to 4.3%, the highest level recorded since 2021. Perhaps most shocking of all, Bureau of Labor Statistics data revealed that the U.S. economy actually created 911,000 fewer jobs in the year ending in March than government officials initially calculated. Treasury bonds maintain their appeal during uncertain times because they carry the complete backing of the U.S. government's financial promise. When seasoned investors anticipate economic turbulence, they frequently redirect their capital into these instruments as a reliable strategy for weathering unpredictable market conditions. Chip Hughey, who serves as managing director for fixed income at Truist Advisory Services, puts it bluntly. The bond market is recognizing that job creation, historically one of the most powerful drivers of American economic strength, is clearly losing momentum. Understanding yield movements requires recognizing what each time frame represents. The 2-year Treasury yield essentially reflects market expectations for Federal Reserve policy decisions and has dropped rapidly as traders adjust to the likelihood of rate reductions. Meanwhile, the 10-year yield serves as a barometer for long-term economic growth expectations. The yield decreases we're witnessing should be interpreted as market recalibration for anticipated economic deceleration, not necessarily recessionary conditions, but certainly softer performance compared to recent years, Hughey explained. The 10-year yield, which serves as a critical benchmark influencing borrowing costs throughout the entire economy, has fallen dramatically from 4.27% at September's start to briefly touching below 4% on Thursday. While declining 10-year yields can translate into lower mortgage rates and more accessible loan terms for consumers and businesses, rapid decreases often signal something more ominous: investor pessimism about economic prospects. Yields are declining because market participants are anticipating slower growth on the horizon, explains Kathy Jones, chief fixed income strategist at Charles Schwab. That underlying assumption drives expectations for Fed rate cuts, specifically because labor market conditions are clearly deteriorating. Matthew Luzetti, Deutsche Bank's chief U.S. economist, announced Friday that he's revising his interest rate predictions upward. Luzetti now anticipates 3/4-point reductions spanning September, October, and December meetings. Recent economic data demonstrates continued labor market weakness combined with somewhat more moderate inflationary pressures than we anticipated, prompting us to accelerate one rate cut from our next year projections, Luzetti stated in Friday's research note. Bank of America has similarly adjusted its Federal Reserve expectations earlier this month. The institution now projects quarter-point cuts in both September and December, representing a complete reversal from their previous forecast of 0 rate reductions this year. August's employment report will likely intensify the Fed's existing concerns regarding labor market fragility, noted Aditya Bave, Bank of America's senior U.S. economist, in his September 5th analysis. The extent of potential rate cuts remains uncertain. Current trader positioning indicates a 96% probability that the Federal Reserve will implement a quarter-point reduction this week, with only a 4% chance of a more dramatic half-point slash. And this is where the controversy really heats up. While employment data suggests economic weakness, consumer spending patterns tell a completely different story. Consumer spending has maintained surprising resilience throughout this year, continuing to support optimistic economic growth projections, according to Bill Mers, who heads capital markets research at U.S. Bank Asset Management Group. Commerce Department statistics show consumer spending increased 0.5% between June and July. Additionally, second quarter economic growth measured by gross domestic product exceeded analyst expectations, painting a picture of economic strength that directly contradicts labor market concerns. Consumer spending remains our primary growth engine, Mers emphasized. We haven't detected signs of that foundation cracking yet, but we're monitoring it intensively because labor market weakening is undeniably occurring at this point. Here's where the situation becomes even more complex. While labor market anxiety dominates investor attention, inflation concerns haven't disappeared from the equation. The Federal Reserve finds itself navigating an incredibly delicate balance, addressing labor market deterioration while inflation persists at uncomfortably elevated levels. The Core Consumer Price Index, which excludes volatile food and energy components, rose 3.1% year-over-year in August, according to Bureau of Labor Statistics data. This figure remains significantly above the Fed's 2% target, creating a policy dilemma. Short-term borrowing rates are declining more rapidly than long-term rates, which signals additional concerns about long-term rate trajectories and their potential decline limits given substantial uncertainty surrounding fiscal deficits, persistently high inflation, and the absence of meaningful downward price pressure, Jones of Charles Schwab observed. So here's the million-dollar question that nobody wants to ask. Are we witnessing the early stages of a more significant economic correction? Or is this simply a temporary recalibration before renewed growth? The answer could determine whether your investment strategy thrives or merely survives the coming months. What's your take on this market contradiction? Do you believe the bond market's pessimistic outlook or the stock market's continued optimism? And more importantly, how are you positioning your own financial future given these conflicting signals? Share your thoughts, and let's debate whether we're headed for economic turbulence, or if this is just another case of bond market overreaction.